Hello and welcome to another episode of ET Market Smart Talk. Well, I'm your host, Shita Janand, and today we are diving deep into the bond market, a space that has been at the center of attention with global trade tension, physical discipline at home, and questions on whether investors should lock in long duration bonds or stay tactical. Well, to help us decode all this, I'm delighted to welcome Suresh Chaudhary, who's head of fixed income at Bandhan AMC. Suresh, thank you so much for joining us.
Thank you, Kshitij. It's a pleasure to be here, and I look forward to our conversation.
Great. Thank you so much for taking the time out. And Swish, let's start with the big picture. With the US tariff escalating and global trade tensions on the rise, do you see a structural impact on global growth and, by extension, on the bond yields worldwide as well?
Kshitij, can you please repeat that? There was a bit of a connection issue.
Sure. No, I was just asking with US tariff escalating and global trade tensions on the rise, do you see a sort of a structural impact on the global growth and, by extension, obviously, on the bond yields worldwide as well?
Sure. So, one has to think about the tariff impact separately, probably for US and the rest of the world, and how it impacts inflation and growth. So, you could potentially argue that growth gets impacted virtually around the world, simply because one, the direct impact or the higher costs associated with the tariff, and second is the uncertainty channel that may in turn impact consumption and business investment decisions. So all told, if you are now a weighted average 12-13% more tariff globally imposed by the US compared to what it used to be before, you should probably shave off a bit from global growth because there are allocational inefficiencies, higher costs, as well as higher uncertainties. Uh, for the rest of the world, the inflation impact is actually not there, or from central banking standpoint, the central banks in rest of the world can afford to therefore focus on the growth impact and not worry about the inflation impact. But US, being the importing country for this, will obviously also have an inflation impact, which is already to some extent getting seen. Although there as well, the Fed for the time being is probably leaning towards considering this as a one-time impact on prices. And because the general state of the economy now is weaker than what it used to be last year, it is probable that the Fed nevertheless cuts into the higher tariffs simply because domestic demand is slowing. So in total, probably the tariff situation is turning out to be probably bullish bonds compared to what the scenario was earlier.
Absolutely. And in fact, another key development has been the recent surge in Japan's government bond yields. And many argue that this could sort of impact global capital flows and even trigger an unwind of the famous yen carry trade. So, how significant do you see this as a global fixed income market?
So, the problem is actually not just with Japan, but a lot of developed markets, if you see. And, one consistent theme is, so you're seeing this across Europe, you're seeing partly in the US, you're seeing in Japan. Market is beginning to build higher uncertainty with respect to future fiscal trajectories and inflation. And in a lot of these economies, this is being expressed as steeper yield curves and more pressure on the long end of the yield curve. Now, what is good news for emerging markets, including India, in all of this is that this is not really leading to capital flight in those markets because, the rise in yields there is fundamentally driven by macro policies, which the markets don't like. So if you see the post-COVID phase, a lot of developing markets, emerging markets, including India, have actually followed very sound macroeconomic policies. They have expanded fiscal deficit judiciously in response to the COVID and then compressed them when the need was not there anymore. They have had conventional inflation targeting, and all of that has benefited with these economies experiencing sound macros, low and stable inflation, and healthy growth. Unlike that, a lot of the Western world was more liberal with fiscal policies. And therefore, it has also caused inflation to be there for longer, although inflation currently is not as big a problem, but the fiscal trajectories still are a problem. So you're experiencing almost a fundamental pressure on the long end of the yield curve as far as a lot of developed market is concerned. But this is also getting accompanied by weaker currencies. So you are not seeing, too much of impact on capital flows to the rest of the world because of higher long end yields in these economies, because fundamentally we are now in a very different fiscal framework in many of these economies versus many developing markets, including India, who remain quite conservative and prudent with their macro policies.
Absolutely. And coming back home, Suresh, the finance minister recently reaffirmed the fiscal target of 4.4% with no sort of additional borrowing. From a market perspective, what kind of impact do you see this having on the trajectory of India's 10-year government bond yields? And also, we saw the recent GST cut that would also, actually could cost government around about 50,000 odd crores in the time being or in the short term.
So one thing I must say at the outset is we have been very impressed with the way the government has handled its fiscal stance over the last few years. So we have had a massive shock in terms of the COVID, and there was need to expand deficit, and they did it judiciously. And when the need was not there anymore to the same extent, they have also taken pains to, rein in the fiscal deficit so that the trajectory is sustainable. And as you know, from next year, we are also moving to a debt to GDP framework where the government has a line of sight on how much of debt the country is running and whether that is sustainable or not as proportion to GDP of the country. So, one comfort that market always has is that the government will be prudent with its fiscal policy. And that comfort does not go away at all. And the finance minister's reiteration was also, a sense of validation for the market that, look, we never thought that the government will stray from fiscal responsibility, and that's exactly what the finance minister is saying, that we have committed to the 4.4% target, we will adhere to it. That said, so the GST impact is roughly around 20 basis points or thereabouts, which is easily manageable. There is also the issue that nominal growth rates have slowed dividend and probably some savings elsewhere in the system. So this year, market is now reasonably confident that the fiscal deficit targets will be adhered to. Next year, we move to a debt to GDP framework wherein the government may have slight fiscal flexibilities, but we don't think, that they will expand fiscal deficit meaningfully. They will remain within a certain conservative framework for fiscal deficit. So when we think about the Indian bond market, we don't worry too much about any sort of undue fiscal expansion, although the bond market recognizes that if growth slows, there is some bit of fiscal expansion that may be required just to offset the cyclical slowdown. But, it is not in the bond market's worry set, so to speak. And therefore, that is a great thing that has happened to the Indian bond market, that fiscal is not anymore a part of the worry set of the bond market. Although in short periods of time, demand supply of bonds obviously have an impact on bond yields.
Absolutely. So from a portfolio perspective, is it the right time to lock into long duration strategies, or would you advise staying tactical or short durations for now?
Kshitij, one of the curious points we have always wondered about as far as investor allocations into fixed income is concerned is, fixed income is the core of any asset allocation for a conservative investor, and it pays coupon income. And yet, fixed income gets talked about tactically always, and equities is the only long-term asset class people talk about. We hope that, although for a growth economy like India, it is quite logical for people to think of equities as the long-term asset class, but we do hope that, the discussion on fixed income also progresses slightly away from it just being tactical and a little more structural in asset allocation tables of investors, especially because, as we know from previous cycles, market cycles and economic cycles is something that we all have to undergo, and it's part of the truth of the system and financial market. So, asset allocation tables also have to gear up to a stage of a macroeconomic or capital market cycle where there is need for preservation of capital as well, and not just growth of capital. And from that standpoint, we think it's high time that investors also consider permanent fixed income allocations a little more seriously. But to answer your point, more directly, these are bond valuations which are quite reasonably good as far as India fixed income is concerned. So we have low and stable inflation. We have reasonably contained current account deficits. We are the fourth largest market economy, so we are also, garnering a lot of offshore interest, which from time to time gets patchy. But if you see over the last 2 to 3 years, offshore interest into fixed income is only progressively rising. And like I said, for the inflation and macro stability we actually have very attractive bond yields in the system today. So this is probably the time to step up fixed income allocation and overall asset allocation, also across a range of investment horizons and market maturities, depending upon the risk profile of investors. As far as the specific shape of the yield curve is concerned, look, a lot of segments of the market yields have risen over the last 3 months for various reasons. So everything from 5-year to 30-year yields have risen. It really depends on what sector you like, what your risk appetite is like. And I would again urge not to consider fixed income as tactically. It is a globally accepted integral asset class in your overall asset allocation table. And even given that India is a growth economy and therefore equity allocations will always be higher, there is room for more permanent allocation to fixed income as well.
Absolutely. And finally, looking ahead, what are the biggest risks that bond investors should keep an eye on? Would it be geopolitics, which is happening quite a lot for the past, couple of days? That's what we are seeing in our neighboring countries. Is it the oil prices or potential fiscal slippages or global liquidity conditions?
So, one great thing about the Indian fixed income market is that it is largely domestically financed. FPI ownership of outstanding government bonds is roughly between 3 and 4% of outstanding, which is, hardly anything. And therefore, we are not subject to as much volatility of capital flow driven price action as we could be if FPI ownership were higher. Although over the next few years, you should expect FPI ownership to also rise. In terms of risks, look, we don't assume too much fiscal risk because of the relatively conservative stance of the government, and that's much appreciated by the bond market. Inflation is on the right trajectory. There's always a risk of flare up of commodity prices because of geopolitical developments, but so far, so good on that aspect. So commodity prices have been reasonably well behaved. We don't think H2 is going to be very great for global growth rate, and that should also cap global commodity prices. There is a near-term issue of demand supply in the fixed income market, which we hope that the RBI is in the process of rectifying. That should also alleviate some of the recent pressures you have seen on bond yields. So all told, we think it's a constructive time to be long fixed income with appropriate risk horizons.
Absolutely. Well, on that note, thank you so much, Suresh, for your time and helping our listeners understand the shifting dynamics of the bond market and giving us a framework to think about the long-term versus the tactical strategies. Again, thank you so much for your time, Suresh, on that.
Thank you, Kshitij. Happy to be here.